There are two areas of blockchain that I see as having world-changing implications. Blockchain gaming and also what we call decentralized finance. Now, the idea of decentralized finance, which we refer to as DeFi, creates much greater efficiencies in making money portable, transferable, removing needless intermediaries. We are finding that smart contracts within blockchain are making it so money is capable of so much more than it used to be. One of the DeFi projects that I have been most excited about is Bumper Protocol. For the last 50 years, option trading has been one of the most significant ways for investors and institutions to hedge their risk. Smart contracts have made it so that there is another way, and Bumper has pioneered that. Today, we'll be joined by Sam Brooks, CTO of Bumper, and the mastermind behind so much of the research, simulation, and complexity that makes Bumper work. And I think you will see why I think Bumper could be the next project that brings about as much change to DeFi as Uniswap did a couple of years back. Welcome to the Crypto Rain channel and our family. If you're looking for crypto news without context, or you're looking for panic selling and FOMOing in, you can find that in a lot of other places, but not here. Because if you, like me, came to crypto because you realized the potential for life-changing gains over a 4 to 8 year period, and you're looking for discussions on becoming a solid and shakeable crypto investor, you're in exactly the right place and the right family. Now, I want you to note that I'm not a financial advisor. I'm a crypto investor myself, and none of this is financial advice. We invited Samuel to join us today, and he agreed to come. So if you haven't already, make it rain on that like button and strap in for the show. And help me welcome Samuel Brooks to the channel. Sam, thanks so much for joining us.
Good to be here. Thanks.
Yeah, we've had Jonathan on a number of times, and he is absolutely amazing and incredible businessman. He explains this stuff very succinctly, and the team I've talked to a whole bunch. I've been actually a fan of Bumper since I first read the white paper a couple of years back when it was very early stages of Bumper, and I was reading it. I was like, man, if they do what they're trying to do here, this will be huge. You're now down the road and released the Mainnet, and it's been years down the road, and I've gotten to know a lot of the team and talked with them a lot. And Jonathan a number of times on the channel. First time having you on the channel. But for those that don't yet know Bumper, or they're unfamiliar with it, what is it that Bumper does?
So currently we call Bumper a price protection protocol. It's similar to it's similar to taking an option. If people understand how an option works, it's effectively you can buy the option to buy an option to effectively ensure the price of an underlying asset. So in the case of like Bitcoin and ETH on platforms such as Deribit, you can go onto those platforms, they're centralized platforms, and you can purchase an option, a put option or a call option, and you can effectively insure against a downward price movement or bet for an upward price movement. And it's a put option is a very common derivative and the basis for the entire derivatives market globally. Bumper does a similar thing, but it does it in a completely decentralized way, and it uses a pooling mechanism as opposed to an order book mechanism where you've got a set of requests to buy and requests to sell on a centralized platform. In Bumper, we completely re-architect and reconstitute those sets of actors on both sides and put them all together and diversify the risk and diversify the premiums and diversify the payoffs, not only between the sets of actors, but also throughout time. And in that way, we can create more reliable outcomes for individuals who don't have to spend lots of time and energy investing in attempting to understand how to price or how to decide whether or not the option that they're buying is fairly priced. They can just enter the pool and understand from the get-go that the pricing mechanism that determines the premium that the buyers of protection pay and the yields that the makers of that protection make are fairly computed. And because that algorithm is open source, because it's in smart contracts, it's on the blockchain, everybody understands the pricing mechanism. Theoretically, everybody understands the pricing mechanism ahead of time. So in that way, we can create something that create something that's very, very easy to interface with. That's like an option. It operates very differently to an option, but the outcomes sort of at the inputs and outputs are very similar. And that so it's easy to use, similar to an option, is very fairly priced, and provides a narrower range of outcomes for people looking to join on either side. And as it turns out, doing that also gives you unlocks all of the efficiency in the buying and selling that would ordinarily exist on an order book style centralized market. If you put all that together, you unlock all of the efficiency or inefficiency that might exist in that market, and then you can redistribute that value amongst all of the participants on both sides in a way that's provably fair.
So in other words, if I were to summarize that, then bumper is more cost efficient in most cases than options for protecting positions or for taking the other side. What kind of metrics have gone into showing that?
So in order to prove the theory, we've had to construct quite a sophisticated simulation, which not only models the economics of the system, but also models quite a number of features of the environment within the protocol operates. So things like failed transactions, slippage, because the protocol will often call out and perform a swap to rebalance itself. So slippage and fees associated with swapping out to a decentralized exchange, all of the incentives and so forth, and of course the premiums and the yields. So we model all of that, and then one sort of straightforward way to understand how bumper might perform in terms of its resultant premiums for takers. So takers are the takers of protection. These would be the option buyers. Is simply to compare the outcome that an individual agent within that simulation receives versus had they would have bought a put option. So you've got a theoretical user, and that user has the choice to either purchase a put option or purchase bumper protection. And you can look at that situation over a number of different agents and over time. And you look at the results of that, and we find that on average, you are better off if you are an options buyer, put options buyer. You are better off instead seeking bumper protection, which is a great result. It's not necessarily something we could anticipate completely without the simulation. It was more a theoretical result. Not really a theoretical result. It was more a conceptual result that might have come about given all of the unlock of the inefficiency of the centralized market. What wasn't known is how inefficient that market actually was. But given that we see the actual numerical results, we find, looking at real options data that we pull in from these centralized exchanges, that there is quite a bit of inefficiency. And so it's not just far easier to use for a similar product, but it's also cheaper.
Yeah, that's interesting, because cheaper leads essentially leading to the kind of protection they're looking for, just cheaper premiums, right? Because protecting, especially at the larger level, sovereign wealth funds, institutions, they have to, the people administering those have to have downside protection, or they're not completing what is called their fiduciary duties, or they're not being responsibly in charge. So they're always thinking about, what are my downside protection options?
Yeah, absolutely. The treasuries, any treasury function that has custody over any significant amount of value, it doesn't have to be crypto, it has to be anything. They have a legal and fiduciary duty to manage that money properly, and that includes managing the risk that the value of those whatever it might be, those assets goes down. They don't only have a duty to. It's not only about building wealth, but a part of building wealth on behalf of others is to protect that wealth in case of volatile market conditions. That's true.
Now, the mainnet is now live as of, gosh, almost 2 months now. How is the mainnet performing?
Exactly as expected, which is good to see. It's one thing to sort of see it in simulation and perform your tests, but it's doing exactly what it's supposed to be doing, which is really, really good to see. The next step in the process for us now is to improve both accessibility, and we've got a number of features that we're looking to implement over the coming months, but also grow the user base so that we have we build up a history of data that unequivocally proves what we find in our simulations.
Some of my community was asking me to ask about marketing and in this idea of growing the user base. What is it that really grows the user base in a sector like this, or how do you go about growing the user base?
That's the $1 million question.
Mm-hmm.
Look, I think that a lot of it has to do with interest in the market, and that comes with cycles. I find that let's say investors in general tend to make decisions about how well a technology or a product performs based on its share price or the crypto prices, that this case may be. It's got nothing to do with how good the technology is or how good the product is, but interest in any given area tends to overshoot in both the negative and the positive. So we get over hypey areas and we get under hypey times. That was one of the first lessons I learned when I actually got into blockchain. That's another story, but
I like to think of it as the pendulum swings too far each way. And I think you hit the nail on the head. I see this all the time in the crypto space. I see a lot of people suggest that projects spend millions of dollars in advertising when the market is generally slow. And what they're hoping for is if they spent millions of dollars in advertising, that would then pump the price when the rest of the market isn't moving at all. And the truth is, should a project do that, it'd be disastrous for the project because it wouldn't have much effect. The best thing a project can do is keep working on the technology and still be around when that wave comes, because that wave is going to come anyway. So a project that all of a sudden drops $10 million on advertising in the bear market is completely unwise. And maybe it will double the token price temporarily and then go back because the new incoming user base isn't there. But when it's growing, say DeFi, when it takes off again, then people are going to look seriously at what projects within DeFi have serious implications. And that by itself, with very little advertising, will catch momentum for your project. But they don't understand that because they're just new to this. And that's totally understandable.
Yeah, 100%. So the other part of the answer to that question is, I think, just looking at fundamental value of the product. So if we can say, if anybody can do something that is exactly the same, offer a product that is exactly the same as an existing product in the market, it takes away one of the biggest risks in any startup, which is the unknown about product market fit. If you're delivering something that's the same but has, let's say, that costs half as much or goes twice as fast, then you know that that's going to have at least some degree of success. So just working on those fundamentals in terms of product is, I think, the other way to grow a user base. And because if there are users out there and you know that they are, and they're pointed towards some other product or service, and you come along with something that's better, then you should be able to have some degree of success by repointing those customers to you.
Agreed. And when you're offering something that protects just as well or better for a lower price, after a while, like, word gets around. And what's funny is, like, I remember the early days of Uniswap. I really heard about it so early. It was one guy programming it, and almost nobody was using it for forever, and didn't put a marketing budget into it or anything. But as the utility of it was used by more and more people, it just grew. And I don't know that they ever put any money into marketing, yet Uniswap is one of the biggest DeFi revolutions that people are like, oh, Uniswap, and they just think it was always around, and it wasn't. And that's just because, a lot of people in crypto are fairly new, and they haven't experienced the history to know how things came about and what led to what. Question though, you've been live for a couple months now. What tweaks have been made in the protocol backend now that the protocol is live and getting live usage? Because sometimes you run into some bugs that weren't seen in testing. Are there already updates being made and some things being made smoother?
We haven't found any bugs or anything that needed significant amounts of adjusting. We have made one update since launch, and that was to increase the range of possible floors that you could protect at. So at launch it went up to 95%. Now that goes up to 99%, and increase the range of possible terms you can protect for. So at launch it was 30 days, and we've added 21, 14, and 7 days to that. And that change precipitated what we call internally as a parameter update, and we had to do some work to redistribute the what we call the risk ratings, which are the distribution of the relative risk between different combinations of term and floor. And so there was a bit of work that went into that, and we updated all those risk ratings, did a parameter update to make sure the premiums were recalibrated to roughly where they were around launch. And that's it basically in terms of updates to the protocol. There have been a few updates and bug fixes to the front end. But what we're focused on now is effectively working on an option for takers to select the option to have a fixed premium that would be charged up front, as opposed to the standard bumper way of charging the premium, which is variable, and it accumulates over the course of the term. So the trade-off here is that in the overwhelming majority of cases, we don't know exactly what that overwhelming majority would be. Let's say 80% of the time, the fixed premium is going to be more expensive than if you had just gone with the standard variable premium. So it's a trade-off. While you don't have a fixed price, and that's absolute price certainty at the start of a position with a standard bumper protection position, you do have a probabilistic understanding of what your premium will be. So you have a range of outcomes, and you know that if you say took out 100 protection positions over 100 days, the average of all of those premiums are going to be lower than what you would have paid on buying regular put options. So it's a trade-off. If you want absolute price certainty, then you would go for the fixed premium, but you would also know that that fixed premium is going to be more expensive than if you take out 100 fixed price premiums, it's going to be more expensive than if you took out 100 variable premiums. So that's that's the main thing we're working on at the moment. It's quite a tricky problem. And there's a few come down the pipeline as well.
Yeah, I wanted to ask you also, for those in the audience new to business development, a project launching and working towards our mainnet is like sprinting a marathon. So I remember reading your white paper over like 2.5 years ago, but then getting to the finish line of the launch of mainnet is like getting to the finish line of the marathon after sprinting it, and finding a new marathon has begun. How is the team feeling?
I think we're feeling pretty good now. Immediately after launch, everyone was completely exhausted. Myself in particular. Very, very unhealthy existence for a couple of years. But now we're all fully recharged. A few of us have had a little bit of time off, and we've staggered that so that we've got continuity of operations. But we are now focused on delivering this next set of features that we'll be rolling out over the next. I think we're aiming for a release at the end of this month, and then we're trying to scope and estimate how long it's going to take to do the next release after that.
Awesome. And Fidimon has a question along the lines of what my next question is. You initially launched on ETH, which means when the bull market gets hot, ETH trading or swapping fees can get very high. However, launching on ETH is a good setup to be able to then move over to an ETH layer 2 or have options on Ethereum virtual machine compatible chains. What is the team looking at in the future for possible chains for layer 2 so that Bumper can be fully ready for the bull market to function as desired, but be able to do all the complex swapping and trading that happens in the background, keeping the positions bumpered with as low of swapping and trading fees as possible?
So Ethereum is designed to not support applications on mainnet. It's always been it's always been the plan for applications, DeFi applications, other applications to actually operate on an L2 or even potentially an L3. So our plan is to move to an L2 as actually the next release. And we're thinking Arbitrum is the most appropriate L2 at this time. And hopefully that is delivered by the end of this month. Now, in terms of that, that's going to have a number of benefits in terms of improving the rate of adoption, even in a bull market. So whereas on ETH mainnet, because the calculations in the protocol are so complex, depending upon the gas price and depending upon how you price it in ETH or in USD terms, it can cost between $20 and $60 to take out a position. So if you're just somebody who wants to play around with the protocol, see how it works, that can be potentially prohibitive. If you've got a small amount of ETH to protect, it's going to be cost prohibitive as well. So Arbitrum, for example, I believe has about 1/100th of the gas cost that ETH mainnet requires. So instead of, say, a $50 transaction fee, that goes down to 5 cents, which, just means it's almost nothing to try the protocol out and see how it works for you. Currently, we support Ether. But with that next release that we're planning on, we also want to support a number of other tokens. At this stage, we think it's appropriate to support wrapped Bitcoin and perhaps staked ETH as well, and maybe one or two other high market cap tokens that exist on Arbitrum at this point.
Wow, this is all coming much faster than I expected. And staked ETH, that is news to me. That's really cool that people can have staked ETH and then protect it while earning a reward on it.
Yeah, because of the way staked ETH works. And we're looking at a way to potentially combine the ETH and staked ETH markets, protection markets. There's some considerations to be made there, but you can imagine that if you say protected ETH and we automatically staked it on your behalf, those staking rewards could go back into the pools and optionally lower your premium if you are holding ETH. Alternatively, if you are still interested in retaining those ETH rewards from staking ETH, then your premium would remain the same, but at the end you would be returned your staking rewards from staking ETH. So there's a few sort of combinations there that we're looking at to see whether or not that's a good thing to do. The main challenge for us at the moment with that is that ETH and staked ETH in terms of price history have been almost exactly the same since staked ETH has existed. However, there's still the possibility that the price of staked ETH might change from ETH. It is not obvious to me at this point why staked ETH is exactly the price of ETH, because it does have slightly different functionality. It does confer a slightly different risk profile because it is staked and often staked through these pools, which haven't been around as long as Ethereum. There may be an underlying bug in there. You've got bridging issues. You've got potentially centralization issues. So for it to have exactly the same price of ETH suggests to me that it's too complex a thing to price. And so the simplest thing to do is to kind of ignore some of these externalities and just match it to the price of ETH. But in the future, that may start to diverge, in which case it'll be tricky to actually combine those two pools. But staked ETH is definitely something we want to support, either combined with ETH or independently.
Cool. One of the questions one of the viewers have, and in a lot of my audience, because I've been following Bumper for such a long time, a lot of them are very interested in what Bumper is doing too, because they've done their own research, and some of them I feel like know Bumper even better than I do. One of them had a really good question. He said, what is the option of pushing the connection to the wallet back a bit to allow people to interact with the protocol a bit before having to connect their wallet? Because when you first go to Bumper, essentially they want you to connect the wallet, but he wanted to know if you could connect up, kind of play around with some different options before then having to connect your wallet, so that people can see some options before making sure they're at the right site and other things before then connecting up their wallet. And I thought, well, that's a good question I hadn't thought about. I'll definitely ask that.
That should be doable. We might add a button that says connect later or something like this, and it would re-prompt you before you did need to actually confirm anything. And at the start of the protect flow, you have to select how much you want to protect, and how much you want to protect. The maximum of that is whatever is within
what your ETH is in your wallet. So it needs to read your wallet at that point to see how much you have in it.
But at which time you can't really play around with any of the settings. So we have to sort of mock something up in order for people to do that. Alternatively, there could be just a slightly separate mode where I don't know, some sort of mock mode or playground mode where it just sort of mocked a position, fake positions or something like this. Depends on interest. I have heard that, and that was something that came up. So yeah, it depends on interest.
Almost like it, yeah. If they could click the simulation mode button, then they could go into that, and that way they could use numbers that might not be in their wallet and just look at some of the options. Makes sense. Will Bumper be publishing? Because I remember when you did the simulation report, which I read through, and it was extremely thorough. And that was done in the testing round before Mainnet went live. So will Bumper be publishing live results similar to what you did in the simulation report now that it's live and you can see what actual positions were taken and how they did and what the costs were?
Absolutely. It's a matter of priority, however. So at the moment, myself and the simulation team are focused on cracking this fixed premium challenge.
Okay.
And there's a large backlog of wants and needs and desires that wrap around the simulation infrastructure. It's not just the simulation, but it's also, telemetry, reporting, the different experiments that we want to run, having not just standalone simulations to do some sort of experiment or analysis, but also a permanent simulation that's running to alert us when we might need to update parameters. But that's a relatively high priority one. I think, shortly after we are successful with figuring out how to do the fixed premium, I think we might look at productionizing some of this. It's going to be more relevant after we move to L2, because that should generate a bit more usage, and you'll get more accurate results the more sort of users you have, and the more data you can produce, the veracity of your results improves. So that is highly desirable. It's definitely on our roadmap, and I would hope that we can deliver something like that updates in real time on the website or on the DApp or somewhere by the end of the year.
It's exciting to me that you're working on Arbitrum, moving over to a layer 2 so soon, and just that, because like e-fees, I just, having been through DeFi summer in 2020 and then the big bull run 2021, e-fees got so exorbitant. And so moving over, like even right now, like Justin was saying, ETH gas fees are on one tonight. And just being able to move over that is going to massively decrease costs. And I agree, it will massively increase people using it, because the cost to play around and test it and actually use and kind of experience go way, way down to just do it. And as people become more familiar and comfortable with it, they will use it, and then they will refer their friends to use it. Like if Uniswap had come around during DeFi summer or later, I don't know that it would have gotten all the traction it did. When Uniswap first came out, the amount it cost to swap things was negligible. It was like a cent or whatever in ETH fees. And so it got so much usage because it was so dang cheap. And then by the time DeFi summer came around, a whole bunch of people were already using Uniswap, and there was a lot of liquidity pools and other things. And so I think going over to Arbitrum is exciting on my end, because I think usage is going to go up a lot because it's just so much cheaper to try. It makes sense to me that it's really high priorities.
Yeah, usage absolutely will go up. And combined with some of these features that we're rolling out over the next couple of months.
Perfect. Let's see. Now, Bumper is discussed an ambassador program. Is that something still in the priority queue? Can you tell us more about that? Or is that maybe another department that handles most of that?
Yeah, I'm not sure. Ask somebody else.
Yeah, that is definitely, it doesn't have to do with your tech experience in your department that you're handling, but I did share with one of my viewers, I would ask that. That's a lot of the questions that I have for now. For those that are in our private Discord, we will be moving the conversation over to there for some private behind the scenes chat, so that you can ask Samuel some questions there. That will not be streamed live on YouTube. The only people that have access to that is in our private Discord. We have time for one or two more questions in the chat. Mike, I'm not going to ask your question. It's just not something I go into on a live. That's something we could ask in the private chat. Would not go into something like that in a live chat like this. It wouldn't be helpful at all to the project to ask that question. Not that it's not a good question. It's a great question, but it just increases exposure, and I don't do that. All right. Let's see. Kind of we answered. While any other questions are coming in, I mean, this is kind of the question that I asked. I did, and maybe we've covered this, but Vidimon asked, does Bumper Roadmap include cross-chain support? Which is a little bit different than the question I asked, or will it just be exclusive to ETH?
If it makes sense to move to other EVM-based L1s, then that is not that much more difficult than moving to an Ethereum L2. So yes, that has been in the roadmap for a long time. But in all cases, it just depends on where we're going to get the biggest bang for buck. When it comes to non-EVM based chains, they're not directly in the roadmap because it's unclear that outside of the Ethereum ecosystem that you would just get the return on investing in those satellite communities to the main sort of DeFi ecosystem.
Cool. Makes sense. Well, I haven't seen any other further questions come in for now. So Sam, I've got your Telegram. Do you mind if I send you the new link there? And I will connect there, and then we'll start a new chat similar to the one we're in right now.
Cool.
All right. Thanks, everyone, for joining us. Thank you, Samuel, for your time. Really enjoyed you joining our audience, and I look forward to the chat in our Discord in just a minute.